Morning everyone, welcome to this policy exchange event, bright and early. We'd like to first of all thank the London Stock Exchange Group for kindly sponsoring today's event, which is entitled Markets for the Many, How the British Public Can Share in the UK's Financial Markets. Just to set a bit of context for today's discussion, obviously the UK economy is recovering, one of the fastest in the developed world, but many people are not feeling as though they're having an equal share in that growth. Ed Miliband has made it very clear that he's going to pursue a more interventionist strand of policy if he gets into government to clean up capitalism, whether it's in the banking sector, whether it's in the housing market, numerous sectors. One of the questions is, how should a Conservative Party respond to this threat that's being levelled at free market capitalism? Especially when many people are feeling left behind, disillusioned, disaffected, disappointed with politicians. In an age of globalisation and increasing technology, what is the role of government and what is the role of business to make the case for an open free market economy, something that alleviates poverty, gives people opportunity? That's what we're going to talk about today. And we're also going to talk about, again, what the role of business is in terms of the way business forms. So how can you give people, employees, an actual stake in a business, whether it be the mutual model, employee-owned businesses, and what's the role that disruptive technologies can play in providing more competition in the marketplace. We've got an absolutely stellar panel, and a very loud microphone, and I will very quickly go through them, although none of them need any real introduction. To my left is Jessie Norman, the Member of Parliament for South Herefordshire and member of the Treasury Select Committee. Jessie has written numerous pamphlets, the most recent, on Edmund Burke.
It's not a pamphlet.
Sorry, it's
a
monstrous novel. It's
a must read.
It's a must read.
You obviously haven't read it. Let's go buy it.
No, the first 3 chapters. No, it's very good. He obviously, most importantly, was a former alumni of Policy Exchange, and last year won Rebel of the Year 2013, I think. Michael Liebright is to my right, the founder of Bloomberg New Energy Finance. He's now the chairman of the advisory board. Bloomberg New Energy Finance, for those of you who don't know, is the world's leading provider of information on clean energy to investors, energy companies and governments. Michael's a frequent commentator in the media. He's a visiting professor at Imperial College London, board member of TfL, and chairman of a medical charity funding research on colorectal illness. So numerous hats. Mike is also, I hope you don't mind me saying this, there are numerous rumours floating around that you may actually put your hat in the ring for the London mayoral nomination for 2016, and apparently you're actually top of the Paddy Power list, ahead of most of the Labour mayoral candidates actually at the moment. So it's a pleasure having you here. John McTernan, on my far right, is a commentator and political strategist who used to work as political secretary to Tony Blair, and most recently was the Director of Communications for Australian Prime Minister Julie Gillard. I'm sure you've all seen John on Newsnight and multiple other TV outlets, or in the FT and the Times, where he's got regular columns. And to my far left is Xavier Rolet, who's the CEO of the London Stock Exchange Group. Xavier joined the LSE Group Board in 2009 and became CEO in May 2009. He's got a varied career, having started off actually as a second lieutenant and instructor at the French Air Force Academy in the 80s before attending Columbia University Graduate School of Business. I am going to kick off by asking Jessie to say a few words.
Sure, well thank you very much indeed, Nick. Thank you, ladies and gentlemen, and fellow panellists. So, markets for the many, the question really begins with what you think has gone wrong, and Nick has appropriately highlighted Ed Miliband's concern about predatory capitalism, and that's an attack on free markets from the left. I'm afraid I'm the author of a pamphlet, a short piece, which is really an attack on one kind of free market from the right. In my pamphlet on crony capitalism, available on jessienorman.com and all good bookshops if they have the brains to stock it. Let's just start with a very boring and fundamental question, which is, what is a market? Now, if you think, this depends on where you come from the political spectrum. If you come from a broadly left or possibly far left view, a market is a hideous disruptive device whose purpose is to enrich the few at the expense of the many, and it requires heavy doses of state intervention to assure appropriate distribution of goods. If you come from a liberal perspective, the market is the unfettered exercise of the individual's free will and should not be regulated, or if it should, as lightly as possible. And I want to suggest to you there's a conservative free market conception which regards markets as cultural artifacts, means of supplying human needs. But because cultural artifacts embedded in history and therefore in human interaction and trust and law, and therefore if they are to be regulated, which in some cases they need to be, then that should be done from that perspective, regarding them as instruments for the benefit of humankind. Now, the reason why that's important is because it then has significant implications for policy terms as to what you then do. If you come from a neoliberal perspective, in which broadly speaking any intervention is wrong, then and you're buying this piece of modern jibbery-pokery known as the efficient markets hypothesis, then you're going to be inclined towards, for example, a competition policy which doesn't really worry, it only worries about what the incentives are of the individual institutions involved, and doesn't worry about industry structure. But I put it to you that you don't need to spend more than 4 minutes looking at our financial markets to worry quite significantly about industry structure. In many of them, just to take the banks for a start, we've got 4 or 5 banks that control well over 50–60% of most of the major markets in which they operate from a consumer's perspective. And that's not a very beautiful thing. When we had a small number of banks, actually we've very rarely had as few banks as we have at the moment, but when we have had, broadly speaking, the trade-off has been this, which is we'll have an oligopoly, and that's okay because, broadly speaking, they behave, they don't take too much risk, and they're more or less targeted on their depositors and clients' needs. It's quite something to have an oligopoly that really isn't targeted on its customer needs. And in the Treasury Committee, we are confronted every other week with evidence, survey evidence, proving what an useless job the banks are doing for their customers. Now, there are 1 or 2 that are doing a very good job for their customers. Handelsbanken, for example. Handelsbanken is a very interesting institution, doesn't spend any money on marketing, thinks that's a waste of time. It grows by word of mouth, and guess what? People who like it recommend it to their friends, and they tend to be good credits, and so it has a wonderfully mutually reinforcing system. Now, they're a very small player, but it can be done better than is being done at the moment, a lot better. At the same time, of course, the other side of the bank balance sheet is that they lend less than 5% of their assets to businesses. You might ask the question, well, what are these banks actually doing, since they're not doing what banks are supposed to do, which is to supply money for businesses and for individuals to be able to lead their lives better? And the answer is they're playing around with it and having a high old time in the interest of their employees and not the interest of their shareholders. And they're doing it with your and my money because, of course, the money they're doing it with is the massive implicit subsidy which they enjoy against possible threat of bankruptcy. When this was looked at by the Banking Commission 4 years ago, that subsidy ranged, depending on whether you believe the lobbyists or the economists, between 15 and 50 billion pounds a year. That's a non-trivial subsidy. That's quite a lot of money for us to be paying to support these institutions. So what do you think about markets then? This is an example of how that then conditions what you think about a particular area, such as competition policy. In my view, is perfectly simple, which is we should pay a lot more attention to industry structure than we are, and there's definitely a case for government intervention in order to make these institutions work a lot harder and work a lot harder in the public interest. Tie that into the absurd explosion in pay that we've seen over the last 20 years, and you start to have genuine concerns about the way in which capitalism is headed. And you don't need to be a rocket scientist, and you just need to be the man on the Clapham omnibus to get very angry very quickly at the way in which CEO pay is lifted off without any relationship to underlying performance or indeed the stock market performance for publicly traded companies. And that isn't pretty either. And it doesn't, again, require a PhD in economics to see that you have what they refer to as an agency problem, which, broadly speaking, the shareholders are empowering the managers to do something, and the managers are walking off with the dosh. And we can come to remedies if you want in the questions. So that's the broad scope of the problem. There is a little bit of good side, the good news. And the good news is that the regulators and supervisors are starting to wake up. It's a rather patchy picture, but I've no doubt that the Prudential Regulation Authority is a significantly better regulator than its predecessor. the bank, when we had Mervyn King in front of us and said, look, how on earth are you going to be able to regulate these institutions when you've basically got exactly the same people, and you can't duck the laws of economics which say that someone will leave your institution if they don't pay twice as much in the private sector. And he looked at us in absolute amazement and said, but they're working for the Bank of England. And actually, bizarrely, that has proved to be a remarkably important thing. The remoralisation that we've seen under Andrew Bailey of those sections of the FSA that went into the PRA has been remarkable, and significant scope for I think, some optimism. But at the same time, the FSA, I think, is struggling in some respects. And I'm not really impressed by many of the things they've done. They've raised a lot of money in fines, but it's not actually clear they've made an awful lot better. Okay, let's keep mutuals, EO, and mass privatizations for later, but I just thought it might be helpful to lay out from a centre-right perspective, from the belief in free markets, what a centre-right critique might look at the situation we've had over the last few years.
Thank you, Jesse. I'm going to hand straight over to Michael.
Very good. So, not just much, but almost all there that I agree with, and that's the sort of lens looking at the financial system, particularly the banks. What I thought I'd do is just broaden it and talk a little bit about two other big chunks of players. One is the people. We can go back to the title of the session, sort of the financial system for the people, for the masses, but also what are we trying to finance? What are the things that you actually try, the industries, the sectors that you try to finance? I'll start with that. Just by way of context, what I do, as Nick said in the introduction, is I built and I sold a business which provides information on clean energy, and this is the transformation of the energy system. And in fact, it's broader than that. It's the transformation of the economy from this kind of centralized, fossil fuel-based, geopolitically unstable economy to something else, and something else will be much cleaner and much better and all the rest. But it requires an enormous amount of money. And then the question is, how does that get financed? And you start to look at through that lens at that system and see whether the money is going to the right places. And the answer is there's enormous gaps. And they're not gaps because the things that you want to do in that transition are uneconomic from, if you like, the economics works. And what you see is gaps in the financing. So you see all sorts of things happening which are undesirable. You'll see banks that don't understand that they're in the banking business. They think they're in the long-term asset-owning business, which pension funds and insurance companies and so on and asset managers should be in. And then they're regulated in such a way that suddenly capital is withdrawn and there's nobody to finance infrastructure, so infrastructure doesn't get built. You'll see we have a venture capital sector which is brilliant at funding early stage, but then there's sort of nothing there when companies get to a certain size, particularly if they have asset-heavy businesses that they're trying to develop. So you have new technologies around sort of industrial type technologies, whether it's energy or whether it's other industrial processes, then suddenly there's no finance available. So we have enormous imbalances, and many of those are caused by essentially poor regulation. It's just a lack of understanding that there's this kind of broad range of everything from technology through to heavy infrastructure and through to public infrastructure as well. And the financial system is poorly positioned because it is forced into buckets that represent, in a sense, a 19th century economy, I think. So we have lots of regulation over retail banking. The only thing that kind of works is real estate, and of course that has now, that has its own problems in this vast bubble that's now occurring through subsidised credit, and the fact that the masses have essentially decided the only thing that's worth saving and investing in is their home, because they have lost trust in every other large-scale savings mechanism that's open to them. What I should also say is that some of the changes that have happened in the last few years, some of the things that George Osborne has pushed through, look extremely positive in terms of resolving that. So, for instance, I will say that I have always had great trust in ISAs, personally, and no trust whatsoever in anything called pension. It's simply, I simply don't believe, and of course history shows with Gordon Brown's raid on pensions and ongoing uncertainty about whether it actually makes sense to put money into a pension. So resolving that, allowing a more flexible use of pensions, but also massively lifting the amount of money that can go into ISA or ISA-type savings measures. That will make a huge difference. That could be one of the big legacies of this government, providing means of savings that actually are worthy of trust. Because I think that broadening from just the banks to other financial players, essentially they are enormous. I've got to be careful what I say here. I don't want to accuse them of being just a huge scam, but the financial system, if you are a saver, has largely been run for the purpose of relieving you of your money without you noticing it. And that just
sounds like the tax system.
Sorry?
Sounds like the tax system.
Well, but the tax system is sort of, we vote for it. We kind of, that is the purpose of the tax system. That is not meant to be the purpose of somebody who's managing my money. And if you work out who gets what benefit from savings, as a saver, it's pretty much 50-50 between you and the financial system, as it currently stands, and sometimes worse. What are the implications for this group? I mean, I think it starts with coming back to the philosophy that I think we've lost our mojo in terms of really believing that people should own stuff, that people should be investors, and not just through the state, but they should individually take responsibility for owning and for their own investments. And this used to be a huge drive, clearly, but we just sort of don't talk about it, and it's almost as though we don't have the self-confidence. And so you have huge discussions about Piketty and the whole sort of neo-Marxist model that we're now told is data-based and so on. But the fact is that if you believe that ownership of assets is what it accrues value and stuff, then the correct answer is to say so everybody should own some of it. It's not to say that we should therefore confiscate the returns from investment. We should democratize the returns from investment. We know this stuff, right? This is what but we're not out there saying it. And so we allow things like the privatization of the Royal Mail without using that as a vehicle to send really strong messages. Okay, that was done by beers and we don't run beers and all that. But we're missing opportunities to say that people need to own stuff, and that's how they will secure their future, not just their home, but stuff. And I think it could be a very exciting time in the next decade if we can sort out some of the things that Josie was talking about, but not just the banks, but also the savings industry, the pensions industry, the life insurance industry, and so on. But also just the new models that are coming along, the ways of investing. Going back to the energy sector, there's an absolutely ravenous demand for capital, and it's not being met by the institutional players, but there's all sorts of ownership, community ownership, mutualization, just different models which could fill that gap. Fabulous high-yielding investments for the long term, which individuals should be interested in, but also models, peer-to-peer models, where we've now got the technology, and you're starting to see whether it's Kickstarter, Indiegogo, these sorts of models, but also peer-to-peer lending models. And these are taking off not so much in the UK in the retail space, but around the world. The developing world is actually leading on this stuff. And also you now see it in the commercial space, where groups of individuals can extend debt to a small corporate because the banks have become so tied up in themselves that they're not doing it. And you get individuals who actually might understand the business of that company, might be able to provide help and therefore de-risk it, and have large amounts of money that they need to apply, and they don't trust the bank to look after it. So you're starting to see a real opening up of new approaches of funneling capital through the system. Of course, by the way, I'd be very interested to know whether the Treasury Select Committees actually are worried about losing control. Because what we have is Bitcoin, where we lose control of transactions. It's extremely difficult to control them. Over in Hong Kong today, you should all be following the news. There's the Occupy Hong Kong, which have been tear gassed, and now they're not being tear gassed. Nobody knows which way it's going to be a huge story for 2014. And the protesters are using an app called FireChat, which is a chat app which doesn't require even a cellular network. Once you've downloaded it, you communicate through the mesh and you lose control of communications centrally. ISIL will presumably be using it shortly in Iraq as well. So you've got to take the rough with your smooth if you go with these distributed mesh-based directions, but finance is going to do this stuff over the next 10 years. Not all of finance, but we're going to see it playing a very important role. And I think, personally, I think it's exciting, but I'm interested to see what others think.
Can I just ask one quick question, Michael? You're an investor in a number of companies. Do you look at the ownership structure when you're thinking about investing?
Well,
starting to see more employee-owned businesses, or?
So, I mean, my own personal, I do some angel investing, and so it tends to be kind of early stage because that's what I like. Other than that, everything I do is pretty much through the least venal team of asset managers that I was able to find. I am interested in mutualization. Just one other thing is, I've done a lot of thinking about the things like the London super sewer, and it strikes me to be absolutely a prime example where we should be thinking about mutualization. If this asset, I'm not convinced we need, is built, then and if its sole purpose in life is to extract money from Londoners, then I think it should be owned by Londoners. So I do think about it, but not in the context of my investment.
There's a mayoral.
Well, no, just as somebody who's a Londoner and a taxpayer, outraged at the things that Jesse has talked about.
Thank you, Michael. Lots to take in there. John.
We're in a really difficult situation. Just consider that in the Scottish referendum, when the banks said that they would leave Scotland, in independent Scotland, because the currency plans of the First Minister and the SNP were so cracked, a huge chunk of people, 45% of the population, trusted the politician and not the banks. And Alex Salmond is the least trustworthy of a profession that doesn't have a very high trust rating. We're a very long way from the politics which I grew up with, when John Smith was described as a bank manager, and that was a compliment to him, not an insult to him. That sense of where business is, if business is less trusted than politicians, then we've got some real difficulties, because like I'm a Labour Party member, I'm a Social Democrat, I'm very relaxed about capitalism, because we need capitalism to create the wealth that we want to distribute and redistribute. We've got a crisis at the moment which is deeper simply than people not trusting banks. There was a poll by Andrew Cooper's company, Populist, just recently, which said that half the population think that the greatest threat to Britain and the future of Britain is big business. 19% think the trade unions. That is a very, very bad figure for anybody who cares about the future of the country. And there's deeper work into brands and types of companies, and I wouldn't be surprised to hear that banks are pretty badly looked on by the public for many of the reasons that both the previous speakers have mentioned. The public are quite canny about this. The brands and the companies they most trust are supermarkets. It's not because they deal with a staple like food, because they hate big food companies. So why do they like supermarkets but hate big food? Well, big food tries to feed you far too many calories, make you unhealthy. Supermarkets work in a very, very competitive marketplace, and people see supermarkets actually, they rise and fall with the marketplace, and so there's something about better and better competition which actually does reassure the public. And I mean, I think Ed's speech was an interesting speech when he talked about predatory capitalism. It's not that it was sophisticated analysis. The responses it got were quite telling, which is that it's some kind of Marxism to say there are good companies and bad companies. There are good companies and bad companies. One of the problems that we have in supporting a market economy is a bit like the cops used to be all the time and are less so nowadays, which is that all companies stand together and defend each other, whereas actually we need some companies to say that's not the kind of thing that you should be doing. That actually is the wrong kind of behaviour. They all know, all the companies know who are the predators and who aren't the predators. And while it's very glib to talk about black and white, good and bad capitalism, there is behaviour that's bad, and it can't only be dealt with by the regulators. There's a peer group pressure, and we need that to be mobilised. I mean, Michael mentioned Piketty, and so just to move on to my advice to the Tory party, I think a big mistake was made this year by Cameron and Osborne. If I'd been in number 10 working for the Prime Minister, I'd have said, get Piketty in, make a speech and say, this is serious. There's a serious concern when a book about inequality is the best-selling non-fiction book in the United States. There's a big issue here, and that we, the Conservative Party, understand this issue better than anybody else. We're not going to let the Labour Party own equality and inequality. They can't manage an economy, they've shown that. Why do you trust them to manage equality or inequality? We're the only party that can deal with equality. And I think the failure of the Tory party to make a march into the area of equality and poverty and redistribution was a failure of imagination, actually, not a failure of nerve. Because I don't think people even thought about it and said, no, we won't do it. They simply didn't think about it. Oh dear, sorry.
Equality.
I'm glad you beat your alarm clock this morning.
That's I know, I'm running for the train in Peckham at the moment. I don't, in terms of actual solutions for the market problem, I don't believe in mutuals. I hate mutuals. I'm somebody who banks with a cooperative bank. I don't hate them that much, but there's a bank which has never paid a penny, a cent of dividend, but its profits, like the Cooperative Insurance Society, were taken to prop up a failing company. Initially the Cooperative Wholesale Society, and then the Cooperative Retail Society, then the whole co-op, and they merged everything together. The problem with mutuals is they are very, very bad at managing hard assets. PLCs are very good at managing assets. Governments are pretty poor at managing assets. You saw that when railway privatisation is a good example. After railway privatisation, well, before railway privatisation, there was a massive attempt to try and find out what British Rail actually owned, and there are hundreds of alienated assets. If you take the cooperative, if you ask older people in any neighbourhood in the country, they can tell you where the co-op used to be, and actually where the co-op dairy used to be, and you can bet that a proportion of those buildings are at some point owned by the cooperative. They don't know where they are. Assets get alienated by mutuals, and they don't manage them properly. And they're also very, very poor in terms of resolving certain issues. And Lewisham Council spent ages trying to transfer a tenants association hall to the ownership of the users of it. Makes sense. The problem was there were two types of users. One was tenants groups, and on Sunday it was used by a black evangelical church. And the black evangelical church only wanted to have things that they approved of run during the week, so they didn't want any groups had anything to do with gays or lesbians. Now that's a problem of ownership that actually in the end the council decided not to hand it over to people, because that requires some kind of political resolution. There are conflicts that can't be resolved in mutual ownership. In the end, it is ownership, I think. Ownership, in its broadest sense, is the solution for capitalism. In one way, I blame Margaret Thatcher, which is that she changed the economic structure of the country for good, as in, forever, but also for good. It was a good thing that she did what she did. But she didn't sell what she was doing. So we still have a pretty economically illiterate country. You only have to look at MPs. When MPs, not on the Treasury Select Committee, but MPs on other select committees, when they get private sector companies who are providing public services, they hunt them down and say, but you're making a profit, as if profit is something stolen from the public. Profit's not a return on investment, it's not a return on capital, it's not a reward for more efficiently running things, it's stolen from the public. The level of illiteracy at the very top, if you regard the House of Commons as being at the top, I've heard a Scottish government minister attacking First Group, which is a Scottish-owned company, because its buses make a profit, and that profit goes, where do you think it goes to? It goes to the City of London, apparently. That's where the profit. This is a minister in a Scottish government, SNP minister. The company's actually owned by shareholders. A large number of them are pensioners, and a large number of those pensioners live in Scotland. One of the big differences that I noticed between British voters and Australian voters is that Australian voters, even working class voters, are actually very economically sophisticated. So when we brought in a carbon tax, we'd focus grouped it, and people said that's a really bad idea. It'll make prices go up, and we said no, that's not true, because it's only we're only going to apply this tax to companies. And they said, yeah, but they'll just pass it on through their prices. And I remember talking to one of the leading members of the Labour Party. He said, why do they think like that? And I said, well, basically, since the 1980s, Australia has deregulated, opened itself to the global economy, and everybody's got compulsory superannuation. And the consequence is that everybody actually watches their super funds, everybody watches stocks and shares, they're owners in the broadest possible sense. So there's something about the ownership in our country which isn't right. That the only form of ownership which has got into people's minds is home ownership, and that was a brilliant thing that Margaret Thatcher did, selling council houses. It's liberated so many people and given them capital assets. We need a broader sense of ownership and a broader set of assets that people own and that people actively manage. And I think that's part of the solution. We still have a huge problem with whatever you call them, good or bad capitalists and predatory capitalists. We've got a huge issue with people's view of the return on capital versus the return on labour. But part of the resolution of this is not simply getting the markets to work more effectively, it's actually to get people to own things more effectively.
How do you prevent a sort of repeat of Royal Mail in terms of if you're trying to privatise a state asset to ensure that it's not just the smart, financial literate city boys who are cashing in? How do you ensure that the general public are sort of seeing the benefits of this sort of mass share ownership you talk about?
You see, I'm like Michael. I was actually doing policy on London when the idea of the super sewer was first come up with, and it's two things. One of them is it's a completely ridiculous imposition on us by the European Union, and the second thing is it's a complete ramp on the customers who live in London. So I think I'd be very happy to see certain assets just given to the public and then let them trade them if they want to. Let them make good or bad decisions, let them take the turn on the market. And I think, let's be absolutely clear about this, nobody runs biz, not even the current Secretary of State for biz. You know, I wouldn't, by and large, I wouldn't let civil servants privatise anything. I wouldn't let them run anything either, so there's a bit of a paradox there. But there clearly was excessive caution in the advice about the price and about all of these things. Just as, you know, at the other end, there was excessive optimism when they gave the advice about raising tuition fees and paying them back.
Can I just add half a second on that? It was from a technical standpoint, it was a very, very poorly executed.
Just
whatever
there's
it
a
really
issue.
got very little to do with, as it were, the merits or demerits of privatisations or that. Just very.
It's got wrong. Let's be completely clear about it.
Yeah, and listen, I mean, there's a far wider range of assets that are currently owned by the government which I would privatise. I would have privatised the underground if I could have done.
Oh yes.
Well, we do have to sell them eventually, don't we? But there's a saying that the French Canadian Prime Minister Jean Chrétien said. He said governments can't pick winners, but losers can sure pick governments.
Xavier, over to you.
Thank you very much. I'm actually deeply encouraged by the sort of cross-partisan display here of ideas, that many of which we've advocated for a number of years now. Let's go back to the sort of loss of confidence. I'll get to Royal Mail in a minute. Let's go back to the loss of confidence, loss of trust. I think it was Thomas Jefferson, the early part of the 19th century, warned against two things in regards to banks. And he said that banks could become like standing armies, meting out destruction and abject poverty to his descendants, to his grandchildren, if we give him two things: fiscal support, i.e. subsidies, and control of the currency. And if you look at except for one, at all the financial crises or economic crises stemming from financial events, certainly of the last 200 years, they all have the same cause, the same effects, and we just do not seem to be able to learn because the same types of crises keep on reoccurring. And it can be attributed to the same single repeating event, our inability to control, monitor, and effectively restrict, to a certain extent, leverage in the financial services industry, particularly in the banking industry. In 2008, there were banks, including certainly one that I know of in the UK, that were leveraged 60 times, 60. Now, 60 times means that a move of slightly over 1.5% in the value of your assets wipes out your equity, your bust. Now, of course, this is governance failure, management failure, regulatory failure. But if you look at why banks leverage, and other financial services, by the way, the ones that are leverage excessively, it's because leverage is subsidized by all of us through the deductibility of interest. And we've now gone through 5 years of regulatory changes where tens upon tens of thousands of pages of new regulations have been passed by Congress, by Parliament, European, UK, Congress in the US. But if you remove subsidy, i.e. deductibility of interest, on the balance sheet of financial services above a certain level of risk, i.e. above a certain level of leverage, we can leave that to central banks to determine what is an appropriate, the PRA we just heard from. You would not have any bank failures. And by the way, you would not have any massive bonus pools, because bonus pools are fueled by leverage. And leverage is a funny thing. Once you start leverage, it's very difficult not to continue to increase leverage. It's not a static thing. Now let's put that thought aside for a moment, and let's go back to the point about how can we ensure that wealth creation is shared. And I fully subscribe to the point that if we want to spend on healthcare, if we want to spend on education, all the things that we've come to like about a welfare system, we need to create wealth to fund it. So it's got to come from somewhere, and that clearly is going to be the public sector. But where does wealth come from? And fundamentally, you can have a very competitive economy, you can have a competitive, flexible labor market, and you can compete on cost with the Brazilians, the Chinese, with the Indians. Frankly, the most competitive economy in the world today is not there. The most competitive economy in the world today is the United States. They're enjoying energy prices that are a third of what they are here in Europe, flexible labor market. But if you're going to be competing solely on the basis of cost, you're going to generate some wealth, but it's going to be hard earned, and certainly it's not going to endear you to your workforce. And what we know, certainly about the capitalist economy, because it's been going on for hundreds of years, is the best way of generating wealth is innovation, which goes back to all the points we've heard. Because innovation generates pricing power. You're building something, offering a service that people want. And therefore you're able to pay better salaries. You also require people with greater education or greater ability to offer that innovation. And these are not the blue chips. They do innovate, but on balance, the sector that by definition always innovates is the small and mid-sized enterprise segment. Now let's go back to the point about leverage, and let's go back to the point about how we finance the 23 million small and mid-sized enterprise, which, by the way, one can match with the 26 million unemployed we have in the EU in terms of the only possible solution to that unemployment problem. Well, when we talk about SME, we always think of bank lending, debt. But what about risk financing? If you're an entrepreneur, if you're starting up something, perhaps you've been in academia for 10, 15 years, you've stumbled on a piece of innovation you'd like to encapsulate in a new business, and you want to create your startup. You go to a bank and they'll say, fine, I'll lend you, maybe might even be Handelsbanken, but they're going to want a lien, a mortgage on your house perhaps, and they're going to want you to service that debt, that interest. And by the way, the bank is not going to be properly remunerated for its risk, because there's a pretty high chance that in the first few years of the existence of your business, you're just going to go bust. That's just the nature of innovation. Not all succeed. Whereas the bank's returns are capped, some sort of spread over LIBOR, and require servicing of debt, which as an entrepreneur in the early years is obviously very burdensome and perhaps even a lien. On the other hand, you have a form of financing that does not require the servicing of debt, that does not require a lien or a mortgage on your house, and where the investor is prepared to take the risk that they're going to lose all their money. In exchange, what they want is unlimited upside, and that's called equity, and it was invented right here. And so, a few hundred years ago. And so if we want to support innovation, create that wealth that's going to pay for our welfare system, realign the parties that are keener on spending it versus the others that are keener on creating that wealth, we need to recalibrate our fiscal system so we do no longer subsidize excessive risk-taking in the financial sector through the deductibility of interest. And we need to remove the many layers of fiscal impediments that have been piled upon equities. And you can look at taxation at the corporate level, at the dividend level, at the capital gains level, and also with our homegrown financial transaction tax, which was set up in 1698 called the stamp duty, which at 0.5% makes the UK equity markets the lowest turnover, most illiquid equity markets in the Western world, and with the lowest level of retail participation. And I was very pleased to hear Margaret Thatcher quoted here, because she understood that ownership was the way to rekindle citizens' support for business. But there was something, and the means to reconcile, if you want, citizens with business, these are not new. The solutions are not very complicated. I'm going to use a French word here, and please forgive me, it's not a bad word, but she created something, or her government created something at the time of privatization, which we called a retail tranche. This meant that the issuer, the government, was required to put a percentage, 20, 30%, just pick a number, of the equity on offer. It was required to make it available to retail investors. We have a tech boom happening in the UK today. It's remarkable. Don't really read about it too much in the press sometimes. But there's 4.8 million, you remember this 23 million SMEs I mentioned about earlier in the European Union, 4.8 million of them are in the UK. It's by far the largest contingent. And in the last 18 months, the UK government has started to take measures to recalibrate the fiscal pressure on equities. Inclusion of young growth stocks, AIM stocks in ISAs, repeal of the stamp duty on AIM stocks, making the EIS scheme permanent, increasing the ISAs. This has had a huge impact on capital raising for these minnows. And that's one of the reasons why there's a very, very powerful tech revolution. Admittedly, these are minnows. We don't have the Facebooks and the Microsofts yet in the UK, but that will come very, very soon. So as that wealth is being created, and for some reason that retail tranche was eliminated, that innovative feature created in the 80s no longer exists today in the UK regulatory environment, giving government as well as companies the option to set up a retail tranche, i.e. ensuring that a percentage of that wealth at the time of issuance not necessarily goes straight to institutions or hedge funds, but is also made available to retail investors, to citizens, is very, very important. And I'm, for one, am convinced, regardless of the merits of the pricing process in the case of Royal Mail, that if 20 or 30% of the shares of Royal Mail had been earmarked for citizens of the UK or residents for retail distribution, the controversy, again, whether this was properly priced or not, the controversy would probably not have existed to the extent that it did. Because if you mispriced it and sold it too cheap, but if the citizens of this country are able to avail themselves of that value investment, it would have created a powerful incentive for future deals. So I think we have the tools here. Equity. We need to continue to recalibrate the fiscal elements that basically historically have made us a debt-consuming society rather than an equity-reliant risk-taking. And I fully agree to the comments that have been made by the panelists earlier. But there are tools that were used in the past and for some reason were discarded that could be resurrected, that could be reactivated, that would make it, and not just for privatization, but in particular for tech companies. We have the opportunity and the chance in this country to be the home of a range of very powerful scientific innovations. Graphene is one of them that often gets mentioned. There's many more. These companies are coming to the market. They raise 10, 20, 30, 40, 50 million pounds. We're not talking about masses of hundreds of billions that would require the setup of government entities to finance. These are retail type, retail size investments. But there's no longer the ability for the retail broking community up and down the country, by the way, this has nothing to do with London, to basically offer at the time of issuance the shares to the public. And were we to resurrect that, I'm convinced that over time the British public would be far more supportive of business and finance than it currently is.
Thank you, Xavier. I'm going to open up to the floor. So if you have any questions, please put your hand up and just say who you are, who you represent, and please ask a question rather than a sort of long statement. Gentleman at the back.
We can choose through the turn.
Yeah, we can do that actually. Yeah, we are pushing this slightly. Gentleman at the back, gentleman in the middle, and gentleman at the front, and then we'll go down this.
Yeah. Andrew McNally from Isha and Bolton. The whole panel clearly agrees that we should encourage more society to own more stuff, as Michael calls it. I think we mean by that productive equity or equity in productive assets. We have an understanding of risk that infuses our regulatory environment, that defines the way the advisory infrastructure works, the way actuaries advise pension funds and so on and so forth. That, well, to me at least seems flawed, but it's created a culture that really says that we should protect people, and the protection of people has resulted, in my mind, in the denial of that broader ownership that whole panel advocates. How do we turn that around? How do you change that whole culture so that we do get into an environment where people do accept that risk is not just risk, it's actually ownership of the future?
Fantastic. Gentleman in the middle.
Will and Sarah Marley from TransferWise. I just wanted to pick Jesse up on something that you said. To completely take your points about the man with capital amount omnibus and concern with chief executive pay, but I'd suggest that consumers are becoming increasingly conscious of the shortcomings of consumer banking. So, for instance, the absence of account number portability, high unauthorized overdraft fees, and for instance, in the foreign exchange market, consumer foreign exchange market, where services are advertised as being free, and then banks sort of take a spread between unfavorable exchange rate in the market. So we also welcome the Treasury Select Committee's work on consumers of financial services. So what would the centre-right analysis be to increase competition in the consumer banking sector?
Question for
Yeah, Ben Hughes from the Community Development Finance Association. We're the trade body for about 60 community development finance institutions that between them lend about £80 million a year into those small businesses that are unable to access finance through the mainstream. I was heartened to hear all of you in slightly different ways cite the challenges we face with the current banking system. CDFI's report inquires totaling 1.5 billion, yet are only lending 80 million. The sole reason for them not being able to lend 1.5 million into this enormously rich market in terms of its percent potential is their inability to raise finance through banks. Very similar problem faced in the US. The solution there was primary legislation. It was the introduction of the Community Reinvestment Act back in the 1970s, which has resulted in a wholesale shift towards investment into this very local, if you like, excluded bit of the finance market. So I suppose my question to the panel is now the time to legislate to get banks to really invest in this bit of the market?
Great, so we've got three questions there. Risk-taking, trust and competition in consumer banking, and legislation. Jesse?
I very much believe we shouldn't all be going around all the questions, because otherwise it's going to be really boring and we won't get many questions. And also, it's been a frighteningly male session so far. I'd like to hear female voices. I was asked a question about increasing competition in consumer banking. Well, the recipe is always the same, right? It's lower barriers to entry, if necessary, break up existing players, and it's remove subsidies that entrench players against new entrants. So those are the kinds of things we need to be doing, and of course it depends on which area of the markets you go. This kind of picks up the point in a way that the gentleman raised, so I can hit two for one. I wouldn't legislate beyond that. I'm not a great believer in legislation. I am a believer in competition. You can tell if there's competition available by and large because you know these activities are generating rather a lot of revenue, which suggests that the market isn't clearing. So we can be fairly certain there's a problem there. Analysis of risk, very quick on the back there. I was going to do exactly what I said we shouldn't do. But it's such an interesting question. Of course, the question is what kind of risk do you want to take and when? The key point is...
How do you change the...
No, I understand. I don't want to feel like it's quickly. Yeah, I'm asking the question of what it is. You have to be careful. If what you want to do is preserve capital, then you'll have a certain kind of attitude towards risk. If what you're trying to do is to adjust for... in many cases, we misunderstand risk because we don't adjust for reward in an intelligent way. So it's like bicycle helmets, right? If you put a bike helmet on, you travel faster because you want more reward for the amount of risk you're as it were, giving up. There's a fundamental further problem, if I can just point out, which is bureaucracies the more accountable a bureaucracy tries to be, the less good it will be at taking risk. That's bank bureaucracies, corporate bureaucracies, as well as state bureaucracies. There's a real problem there. A lot of those bureaucracies could function better if they alienated power more and therefore gave themselves the capacity to fail on a local scale. Michael.
So I'm not going to answer any of the three questions. Jesse's done such a marvelous job. But I want to bring it. There's something missing here, which is the idea of shame, because all these are about behaviours, well, particularly the risk question. It's about behaviours and regulation, and we've got this great big book, and it might not be the right book of regulations, and can we have a different book of regulations, and so on. The problem is that the finance sector innovates, as Xavier said, and it will innovate its way around pretty much any regulation. It will find a way around. So if you say a behaviour is okay, and then you turn around and say, oh, we've got a new regulation, it's not okay, they'll simply say, oh yes, if we do it in the Cayman Islands, catch us now. And you just won't be able to innovate fast enough on the regulatory side to catch all of that. At some point, you just have to say, this stuff is wrong. And you have to get back, if you go back in history, the great bankers were bankers who actually financed the construction of cities, of communications networks, of infrastructure. They rescued cities, New York in the 1980s and so on. And that sort of role of banking is what we all want, and not the sort of daft, what is it, the Christmas, what's the great film, where the banker sort of strews money out and everybody thinks it's absolutely fantastic, wonderful life. It's not that model of banking. But these have got to be, the role of banking is to produce assets and businesses and services that we all use. And I think that you'll only really do that if there is, I hate to say it, but it's a return of sort of morality and shame. And if you look at what happens now, if a bank manipulates an index and gets caught, and you slap an $800 million or a $5 billion, it doesn't matter how big the fine is, everybody knows that what happens is that fine gets passed on to either the shareholders, if it's a public bank, if it's RBS, or to its clients, if it's not. And so there is essentially cutting corners and doing this stuff is a risk-free activity for the directors of those institutions, and that has to stop. I think I can't see why banks that were engaged in those sorts of activities, why any of the directors who were directors at the time should still be considered fit people to be directors of financial institutions. Because if they knew about it, they're not fit. And if they don't know about it, then they're not fit. So they're not fit. So why do we treat them as fit? Right? And then, of course, you have all the issues that spin off from that of loss of trust in the public. And then you come up with it. You can have bigger and bigger books of regulations. You'll never fix it. You'll never fix it through regulation.
Just conscious, I want to get some more questions in from the floor. So, lady over there, thank you. Gentleman here and gentleman there.
Katie Evans, Social Market Foundation. Michael, you mentioned ISAs, and we're talking about how we can open markets to the many. Most ISA holders just hold cash, and there's a general lack of willingness to take risk among household investors. I believe if Royal Mail shares had been more widely available, you'd still only have a very narrow section of the population interested in buying them. Can we do anything to make the population more interested in taking investment risk?
We'll come back to that. Gentleman here.
Following on, interesting for now, I was the author of the cash ISA transfer service and the account switching service at a technical level. So I work for a company called Vocalink, and I've had some thinking about how we can actually achieve this. And my view is that at the moment, buying equities, you either need to be very rich in a pension fund to afford to understand it, and what we haven't done as a society is created a low-cost utility model for earning assets. And the reason this is dealing with millions of people is too expensive, and the banks will not touch it because of KYC and AML and the threats coming from overseas. So it's incumbent upon government to take what they're doing with identity and identity across Europe to allow those things in the bank's KYC to be reused, and for the payments industry to allow buying and selling of assets just simply as you'd make a normal payment. So I should be able to send a payment for shares in British Gas to the stock exchange, and they'll be owned in mine. And as long as they're reversed out and there's no market side trading, there is no risk, because it's just like owning another currency.
And this gentleman here.
Yeah, I want to ask about challenger markets, because actually we've talked a lot about banks. Banks aren't a market. A market is a market. Xavier runs a very good one, a very high class one. But actually the way that people invest is they invest between each other, and a market takes a justifiable turn on the way through. And what I want to see is how we can explain this to the FCA, who do not understand this at all. Part of investment is risk. I have made money and I've lost money on many occasions, and that doesn't make me a bad person. It makes me sometimes a foolish investor, but I go and I invest because that's one of the things I do. But if the FCA believes that some investments are too risky for me, or indeed that I'm not clever enough to understand, and instead I should go to Standard Life, where if Standard Life gets it wrong, they can fine it millions of pounds. But they're happy then for Standard Life to charge, to make a less than 2% return on its unit trusts and feed me that. We will never have mass ownership. And challenger markets, to me, are the way we do that. We seem to be now strangling the crowd lending, crowdfunding.
Can I ask Xavier on that last point, if you want to address
Yeah,
that?
there's a couple of points I'd like to make in the process as well. But the power of competition is immense. If you look at low returns in the mutual fund industry, and if you look at the variable that fees represents over the life of an investment, that's why you have companies like Vanguard in the US taking the market. They've just passed $3 trillion because they charge a fifth to a tenth of what the rest of the industry charges, and they're still making a good return. So you need more competition in the asset management industry so as to improve the returns over time, including equity returns. I think the point about the FCA and regulation, it's quite clear on the back of the crisis, the 2008 crisis and financial crash. Regulators in general have become very risk averse and are looking at all activities through a retail protection filter, which is not so much have the issuers comply with the prospectus directives, but how do we avoid any losses from happening under any circumstances? And that's their approach. And that's why if you apply this filter, we're not going to have a capitalist economy anymore. I would raise another point about competition, which is one that we've heard from you, sir, earlier. Most European countries, UK included, have incredible concentration of the banking industry. If you take the 3 or 4 largest banks, that accounts for 2/3 to 3/4 of the market. And it's not just corporate lending, which is dependent on bank lending to about 70% in the European Union, but it's also mortgages, it's retail, deposit collection, and so on and so forth. The one country in Europe where there isn't a problem about lending to SMEs is Germany. In Germany, the 3 largest banks account for only 12%. 3 largest banks, 12% of all deposit taking, mortgage, and wholesale finance. So there is clearly a competition issue there in terms of the distribution of capital. I think the point that we've heard about investment, the point you made, sir, is very much also driven by financial education. There needs to be a lot more economic but also financial education in school at early stages, colleges, and of course university, because people today do not really understand how markets work. There's a very, very clear issue there. I think fundamentally the point about morality is the correct one. But as long as, I'm sorry to use blunt word, as long as the state provides the wrong fiscal incentives, there is no amount of morality in any business, whether finance or anywhere else, that ultimately will stand, including shareholders, in the way of the subsidization of leverage. Again, it's not a static tool. Once you leverage, you need to leverage more to basically keep your returns. That's what fuels the bonus pools, that's what fuels the growing greed, and of course, which translates more quickly in the financial industry because its commodity is money, but ultimately basically percolates into the wider economy. We need, and by the way, this costs European treasuries tens of billions every year. We need to look at ways to reduce the subsidization of leverage. That will help provide the right incentives for true return adjusted for risk, and that will help cure, together with ultimately giving an incentive to those morally minded. A morally minded manager in an environment where leverage is subsidized, he or she does not survive. You get carted away by your shareholders. So you need to give the right incentive for morally minded managers to be able to succeed. And this is, in my humble opinion, the greatest responsibility of the state, is to recalibrate the fiscal background that gives excessive incentive to those who leverage their balance sheet too quickly or excessively.
John, do you want to pick up on any of the questions?
Yeah, I think, competition is the answer, but let's be absolutely honest. We do not have a political class on either side of the House of Commons who believe in competition. We have people who live, anybody who knows the air industry knows that BAA use their power to force people to fly to Glasgow, not to Prestwick, because they won't get a slot in Edinburgh Airport if they don't fly to Glasgow. No one wants to fly to Glasgow Airport. They all want to fly to Edinburgh, but you're forced to. You've got to buy a slot in Glasgow before you can have a slot in Edinburgh. Everybody knows that happens. Is anybody going to do anything about it? No, because BAA are very good at sucking up to politicians. We don't believe in competition in this country. We don't, right? So we need politicians who actually believe in competition. And obviously, in my view, breaking up the banks that we own would be a good start. Just because it couldn't be worse than what we've got. I think it's a leadership issue. I think to answer the question about, there was a very fair question about how do you broaden ownership and how do you, there's lots of technical things, but what we want is the ends, not the means. And we've been talking about the means quite a bit today, and that's important. We probably need to look at what Margaret Thatcher did about home ownership. What she actually did was sell people something at a very discounted rate, now, it's transfixed people. Home ownership has transfixed people as the only form of ownership. If we want people to learn about risk, the best way to learn about risk is taking risk. So the best thing we should have, the greatest thing we'd have, is an assumption through school and through university and through further education and at work, that the people who are at work are going to be thinking about setting up a business. Setting up a business and either driving innovation, as Xavier said, or actually failing. They're both great ways to learn about risk taking. And I think it's the broader culture of, again, there have been so many political parties and so many ministers talking about small and medium-sized enterprises. Is there one single policy that's ever been produced in practice by a government, Labour or Tory or the coalition, that has actually helped small businesses or medium-sized enterprises? They talk about it, but they don't do it.
Really just very quickly,
Very last point.
SEIS and EIS are vast. Well, actually, you can call it a subsidy, or you can call it, because the tax treatment of SEIS, you put £1 in, you get 50 pence back. You're exempt from capital gains tax. You're exempt from estate tax. And if you lose your money, then you can write it off against capital. It's fantastic. Now, it's not a subsidy because all those taxes were your money to start with. But that is hugely important, and I think moving those into ISA RAMs, that is enormously significant. just know your client. The costs thing, absolutely spot on. Know your client is the biggest load of bullshit. Because anybody who's really money laundering is going to get round those rules. It's a vast imposition of cost on everybody. It reduces competition. It's so there's lots of technical things. I could continue for longer than Nick will give me.
I'm afraid we are actually going to...
I'm all good.
I'd just like to thank all of you for coming today, the panel for a fantastic discussion, and London Stock Exchange Group again for sponsoring today's event. Thank you.